more money, mastering the concept of supply and demand is crucial. In this video, I'm going to walk you through everything you need to know about supply and demand in trading. But before we dive in, let me just say this: if you really want to master this, stick around and watch the entire video. Skipping parts could cause you to miss out on some valuable insights that could be the difference between winning and losing trades. So here's what's coming up in this video. First, we'll break down what supply and demand really mean in the trading world and why mastering this concept is a game changer. Then, I'll show you how to accurately identify supply and demand zones, followed by practical strategies you can use to trade these zones effectively. And for those of you looking to level up, I'll also share some advanced tips, including my personal strategy for trading supply and demand. So why you should study and trade supply and demand. Before diving into any business, it's crucial to understand every aspect of it. This principle holds especially true in trading financial markets. Without a solid grasp of how the market functions, consistent profitability will remain elusive. In the trading world, there are two key players: market makers and retail traders. Market makers, which include banks and financial institutions, are the dominant forces in the market. These entities trade millions of dollars every day, holding the power to manipulate and move prices at their discretion. These market makers have access to top-tier technical analysts who understand precisely how retail traders operate. They know where your stop losses and profit targets are set, and they can manipulate the market to take your money whenever they choose. This is the harsh reality that many traders are unaware of. Let me give you an example to illustrate how market makers exploit retail traders and how they manage to take money from you. Consider the Australian dollar Swiss franc daily chart. As the market approaches a significant key resistance level, a doji candlestick forms, creating a false breakout, a classic sell signal that many retail traders would act upon. As a retail trader, you might decide to sell after the pin bar closes, placing your stop loss just above the resistance level. You enter the trade feeling confident and excited, but look at what happens next. The market hits your stop loss before eventually moving strongly toward your initial profit target. When your stop loss gets triggered, you might feel frustrated, as if someone is watching your every move. This is a common scenario in all financial markets. If you're unaware of these tactics, you'll repeatedly fall into the traps set by banks and financial institutions. Here's another example. Imagine the market is trending downward. After a support level is broken, breakout traders rush in, expecting the downtrend to continue. If you're trading breakouts, you enter the market confident that the trend will persist. But then, something unexpected happens. After the support level is breached, banks and financial institutions change their strategy. They know that a significant number of retail traders have jumped in to capitalize on the breakout. To trap these traders, they employ what's known as the false breakout strategy. If you're savvy to this tactic, you could buy after the trap is set, turning a potential loss into a profitable trade. Financial institutions operate within certain zones where they buy and sell in the market. If you can identify these zones, you can align your trades with theirs, profiting alongside the market makers instead of trading against them. Let me show you an example. Take another look at the Euro-US dollar 4 hours chart. Notice the strong downward movement represented by the series of red candlesticks. This move was initiated by banks because they deemed the price favorable. When the market retraces to test this zone, the same banks re-enter and other institutions jump in as well, driving the price down again. Look at what happened next. The market plummeted when the price retested the zone. This is a strategy banks and financial institutions frequently use. By recognizing these zones, you can easily profit from these trades. If you study your charts, you'll find that such zones appear regularly. The examples I've shared are just a glimpse into the strategies that market makers use to manipulate the market and extract money from retail traders. In today's video, we will dive deep into studying supply and demand so that you can trade like the big players instead of falling victim to their traps. So what exactly is supply and demand? At its core, supply and demand in trading refer to areas where there is aggressive buying or selling. These are the zones where big players like banks and financial institutions are stepping in, moving the market in a particular direction. When you see large momentum candles on your chart, whether they're red for selling or green for buying, it's a sign that these big players are at work. These momentum candles show us where the smart money is, and that's exactly where we want to be. However, if you see small, insignificant candles, this is not where the action is. These small candles represent weak trading activity and indicate that the big players aren't involved. So focus on those bold momentum candles as they reveal the areas of true market movement. So how do you identify supply and demand zones? Let's get practical. The first step in identifying these zones is to look for at least 3 consecutive momentum candles of the same color, green for demand or red for supply. These candles indicate strong buying or selling pressure. Once you've spotted these momentum candles, the next step is to identify where the move began, usually at the previous candle before the momentum started. Use a rectangle tool to draw a box around the high and low of this candle. This box becomes your demand or supply zone. The key here is to wait for the price to return to this zone before you consider entering a trade. Let's go through some examples. Imagine you see 3 strong green candles forming in a row, signaling a demand zone. To find where this buying pressure started, look at the previous red candle. Draw a box around this candle to create your demand zone. Now, when the price returns to this zone, that's when you start looking for buying opportunities. On the flip side, if you see 3 red momentum candles, this indicates a supply zone. You would then find the last green candle before the drop, draw your box, and create your supply zone. When the price revisits this zone, look for signals to enter a sell trade, trading supply and demand demand zones isn't about jumping in as soon as the price hits the zone. Instead, it's about waiting for confirmation. For example, if the price returns to a demand zone, you should look for a bullish pattern like a doji or a bullish engulfing candle before entering a buy trade. These patterns indicate that the buyers are stepping in and the price is likely to go up. Conversely, if you're trading a supply zone, wait for a bearish pattern before entering a sell trade. This shows that sellers are gaining control and the price is likely to drop. Here's where many traders go wrong: entering trades too early. Don't jump into a trade just because the price enters a supply or demand zone. Always wait for confirmation to avoid false breakouts, ignoring the bigger picture. Always consider the overall market context. For example, if the broader trend is bullish, be cautious when trading supply zones as the market's momentum might overpower the zone. Overtrading. Just because you've identified a zone doesn't mean you have to trade it. Be selective and only trade when the setup is strong and the conditions are right. Now, let's take it a step further with an advanced strategy. One of the most powerful techniques you can add to your trading arsenal is identifying what are known as golden zones. These zones are areas on the chart that align with the 50% and 61.8% Fibonacci retracement levels. Why are these zones so special? They're not just random levels on a chart. They represent areas where banks and large financial institutions are most likely to buy and sell. These zones hold the Fibonacci golden ratio, a mathematical principle that is deeply ingrained in nature and, interestingly, in human psychology as well. The golden zone strategy taps into the innate tendencies of market participants. The 50% retracement level is a critical point where traders often begin to reconsider the direction of the market, while the 61.8% level, known as the golden ratio, is a psychological level that traders subconsciously respect. This ratio influences human behavior, making these zones incredibly powerful in predicting market movements. Here's how it works in practice. Suppose you've identified a demand zone on your chart and you see that the price is beginning to pull back. Instead of jumping in immediately, you can use the Fibonacci retracement tool to measure the swing low to the swing high of the recent price movement. What you're looking for is alignment with the 50% or the 61.8% retracement level. When your demand zone overlaps with one of these Fibonacci levels, you found a golden zone. Why is this significant? Because these are the areas where the big players, the banks and institutions, are likely to step in. They understand the power of the golden ratio and use it to time their entries and exits. By identifying these zones, you're essentially positioning yourself to trade alongside the big boys rather than against them. Let me share with you my personal strategy for trading these golden zones. Identify the zone. First, I start by spotting the supply or demand zone using momentum candles, just as we've discussed earlier. Look for confluence. Then, I bring in the Fibonacci retracement tool and check if the zone aligns with the 50% or 61.8% retracement levels. This confluence of signals strengthens the case for a trade. Wait for confirmation. I never rush into a trade. I wait for a strong confirmation, such as a bullish or bearish candlestick pattern, to validate the zone. This might be a bullish engulfing candle at a demand zone or a bearish engulfing candle at a supply zone. Risk management. Proper risk management is crucial. I set my stop loss just beyond the zone below the demand zone or above the supply zone, minimizing my risk in case the trade doesn't play out as expected. Set realistic targets. I aim for logical profit targets. This could be the next supply or demand zone, or if you're following the Fibonacci path, a key Fibonacci extension level like the 127.2% or 161.8%, which often serve as natural take profit points. In practice, this golden zone strategy might unfold like this. Imagine you've spotted a supply zone and the price begins to retrace. You apply the Fibonacci retracement tool and notice that the 61.8% level aligns perfectly with your demand zone. This overlap creates a powerful golden zone. As the price approaches this level, you're not just looking at numbers on a screen, you're seeing where the big institutions are likely to place their trades. Next, you wait for a confirmation signal. Let's say a doji candle forms right at the 61.8% level. This is your green light to enter the trade. You place your stop loss just above the supply zone, ensuring that your risk is well managed. For your take profit, you could target the next support level. Why does this strategy work so well? The answer lies in the psychology of the market. The Fibonacci levels, especially the 61.8% retracement, tap into the collective behavior of traders. These levels are not just technical, they're psychological triggers that influence the decisions of millions of traders worldwide. By aligning your trades with these levels, you're essentially riding the same wave as the market makers, positioning yourself to profit alongside them rather than getting caught in their traps. Incorporating golden zones into your trading strategy can dramatically increase your accuracy and profitability. It's a method that combines technical analysis with the deeper psychological aspects of trading, giving you a more holistic approach to the markets. By mastering this strategy, you're not just trading, you're trading smart, aligning yourself with the true movers of the market. Mastering supply and demand is just the beginning. When you add the power of Fibonacci and golden zones into the mix, you elevate your trading to a whole new level. These are the strategies that can help you trade like the big players, maximizing your potential for profit while minimizing your risk. If you found this video helpful, be sure to like, subscribe, and share your thoughts in the comments below. I'm here to help you on your trading journey, and I look forward to seeing your success. Happy trading, and I'll see you in the